This is always a very, very popular topic, and I know there's been some changes. There are going to be some upcoming changes with estate gift and capital gains taxes. That's definitely could have an effect on landowners and farmers, especially in Wake County. Jason Page, an attorney with the law office of Jason R. Page, has also been a great friend of ours in the stormwater office, has been a part of this Keeping the Farm for many years. And as always, he works with a lot of large landowners and farmers, and he knows the ins and outs and how these kind of impacts could affect you, and very knowledgeable. So I'm glad he could be with us virtually this year. And Jason, I'm gonna let you take it away with your presentation.
Thank you. I'm gonna see if I can share my screen. All right, so I'm going to try to talk about something that we could talk about for days in 20 minutes, and it's something I've been studying pretty much my whole adult life. So I'm not sure I'm going to get through everything in the detail that you might need, but I do represent a lot of farmers and rural landowners. I was a forester before I went to law school, and I also grew up in Wake County. So I've done this program for several years. So I know there are a lot of the background things that would affect people. So the first thing I have to say is this is not legal advice, and you need to hire your lawyer, and I know that Lawyers Mutual will probably appreciate me putting all that in here. So there's lots of taxes we could talk about. I'm going to focus on the transfer taxes today, but there's gift tax, estate tax, generation skipping transfer tax, capital gains tax, and then ordinary income tax. And we have to separate those, and there's all kinds of different rules that apply to each one. So the transfer taxes are the estate, gift, and generation skipping taxes, and this is unrelated to income. These are just your ability to transfer wealth to someone else is taxed if it's over the exemption amount. And the point of this is to keep you from becoming increasingly wealthy over generations and generations. And so that what the government determines is too wealthy has changed over the years. And right now, as we'll see, we're in a pretty high exemption period. So to understand why this matters and how it works, we have to first understand what the gross estate is and how it's taxed. So the definition in the Internal Revenue Code of the gross estate is pretty much everything you own in the whole world. And it's actually probably a little more broad than that, because there are things like incidents of ownership in a life insurance policy or a general power of appointment under a trust that you may not even realize would be considered part of your gross estate. But we have to take that gross estate and then subtract the deductions to determine your taxable estate. And the deductions we'll talk about today are mainly the charitable deduction and then the marital deduction. And so we'll get to that in a second, but we also have to look at reportable gifts. So there's right now this unified credit amount, which is $11.7 million for this year. And so we take your taxable estate and then we add your reportable gifts and we subtract out your unified credit, and that's the taxable amount. And that's a pretty large oversimplification of that, but it gets you the gist of what we're trying to do. And basically, if that amount that's left is more than $1 million, you pay 40% tax on that transfer of wealth. So that credit amount is what matters. And right now, that amount's 11.7 million. The way that number is determined is we take $10 million in 2010 and adjust it for inflation. So every year it goes up a little bit. Inflation's a strange thing because we have inflationary things and then we have deflationary things and then we have whatever they use to measure inflation. So the inflation rate might be 2% while the value of your house went up 50%. It's not going to be always something that makes sense. One issue that we know we have on the horizon is that in 2026, that credit will be reduced to $5 million in 2010, adjusted for inflation. So in 2025, you could have a $12 million exemption, and then January 1, 2026, it could go down to $6 million. The Biden proposal during the campaign was to reduce that to 2009 levels, which was a $3.5 million estate tax exemption with a 45% maximum rate. I don't think that this is going to be the top tax priority. What we're hearing is that there's an infrastructure focus, and that would likely be funded with an increase in corporate taxes and maybe an increase in income tax on people who make over $400,000. And the corporate tax is beyond what I deal with, but we do know it's out there on the horizon, and we know at least it's going to be cut in half if the law is not extended, and I doubt there's going to be an appetite right now to extend the Trump era tax rules past 2026. So the marital deduction, the charitable deduction, and portability are also important concepts here. So you can give your spouse, if your spouse is a U.S. citizen, as much as you want to without tax. You can also leave a charity an unlimited amount. And there's obviously lots of rules around both of these, but if you do it right, you can defer estate tax until the second spouse dies. And any unused exemption amount can be ported to your spouse. And it's important to know that that is not automatic, that you have to do something to port that unused exemption. And what you have to do is file a Form 706 estate tax return and elect portability. So if you die this year with a $2 million estate and it goes to your children, then you have $9.7 million left that could be ported over to your spouse. And when there was an $11.7 million exemption, and we're not really too worried about it going down in the near term, you know, most people didn't think much about making a portability election. I think that's going to become more important over time. But as I said earlier, with proper planning, you can avoid estate tax liability when the first spouse dies. This makes my head hurt to just think about this, but if there is a generation skipping transfer tax as well, and I wanted to mention it just so you know it's out there. It really doesn't affect you unless you have a taxable estate. But the essence of this is the government wants to get their tax at every generation. So the law taxes direct skips, taxable distributions, taxable terminations that are above the exemption amount. The easiest way to explain that is that if I have a $20 million estate and there's a $10 million exemption, and I leave and no spouse, and I leave $10 million to my child and $10 million to my grandchild, well, the effect of that is your child would not be taxed at his or her death on that second $10 million. You're trying to avoid that second taxation. So they're going to go ahead and impose a generation skipping transfer tax now. So what you'd want to do is make the allocation to the GST to the grandchild. And you know, that example I gave is, again, an oversimplification. There are automatic allocations, and that might be an automatic allocation. I don't know. But the point is, you can't just skip the generations and not pay the tax at the next generation unless you're under the exemption amount. And GST exemption right now is the same as the estate tax exemption, but they can become decoupled. So if I give my son $1 million, and that comes off of my estate tax exemption, but it would not come off of my GST exemption. So you end up with exempt and non-exempt trust shares. And that can really be confusing, particularly in a marital trust with a reverse Q-tip trust, which I won't go into now. But the point is, you have to think about it if you're wealthy enough for that to matter. Basis is what matters to most people, and capital gains, while there's a big estate tax exemption, we always want to get that basis step up so we avoid the capital gain tax when the property is sold. So if you think about what that is, a capital gain is just a gain that's realized when an asset is sold at a price higher than its basis. And there's long-term capital gains and short-term capital gains. So if you bought Coca-Cola stock in 1980 and it was $10 a share or something, and you held it until now and it's $50 a share, you have a basis that's pretty low in that stock. So when you sell it, you'll owe a long-term capital gain. But if you bought GameStop in December for $18 and you sold it for $300 in January, that's going to be treated as ordinary income because it's a short-term capital gain. And what we're looking at here is land. So when you inherit, that's going to be a long-term capital gain. So generally, property that's included in your gross estate will receive a basis adjustment upon your death. So and I just said property inherited at your death, if you sell it, it will be treated as a long-term capital gain. You don't have to wait a year if you inherit it. Your basis is adjusted to the fair market value on the date of death, but that's if it's included in the gross estate. And the current maximum long-term capital gains rate is 23.8% versus, I think, 37% for ordinary income. So it's a pretty big difference. And we do see problems with someone losing the basis step up. For instance, I give my property to my children and I don't do something to pull it back into my estate, like a life estate, a reserved life estate, then they don't get a basis step up. They get my basis in it. The Biden proposal is to eliminate the basis adjustment and also to tax capital gains as ordinary income if you make more than $1 million a year. Eliminating the basis adjustment would be a big deal for rural landowners. And also, it would be a big deal for other people as well. I mean, think about if your parents bought a house in 1975 for $25,000, and then when they die, it's worth $225,000, and you sell it right now, you don't pay any tax on that. If the basis step up goes away, then you'd have $200,000 in capital gains. So that's $30,000 to $50,000 some in federal tax on that. So it can be a pretty big deal. And I've said basis step up. It could be a step down. It's really just an adjustment to fair market value. So where that leaves us right now is that for estates that are definitely not going to be taxable, you can focus on maximizing the basis. So ensure that it's in somebody's estate when they die so that you get a step up. And the planning strategies to use can ensure successive basis adjustments. So you could leave property in a way that stepped up when one spouse dies, also stepped up when the next spouse dies, also stepped up when the child dies, going to grandchildren. You can focus on other planning issues as well, like asset protection or keeping land in your family, and not necessarily let taxes determine what you do. And for states that are fairly small right now, and small is a relative term, but if it's possible that it could become more than $3.5 million later, you should consider making a portability election, because we don't know what your spouse's exemption might be 3.5 while yours is 11.7. The estates that could be taxable, where we're sort of in a unknown territory, and that's a broad range of estates, because if you have $3 million estate right now, that might be a $7 or $8 or $9 million estate later. And we don't know what the exemption amount might be. It might go down to 7. It might stay where it's at, and you don't have a taxable estate. So flexibility is the key in these size estates, especially if you're married, because you need to be able to maximize basis if that is in your best interest, but also protect from estate tax in case the exemption goes down. And we'd be talking about a difference between selling for if you sold later, dealing with the basis on the date of your death versus paying a 40% estate tax. So most people, when forced with the choice, do I take a carryover basis when the spouse dies, or a child dies, or do I pay a 40% estate tax now, would probably pay that 23.8% later versus 40% now. So there are some second look strategies like a disclaimer trust and a Clayton election that can be helpful for married couples. And for example, a Clayton election says, I'm leaving my share to a bypass trust that will be in my estate, but will skip my spouse's estate. But if my wife or husband makes a Q-tip election, it goes to a marital trust that would get a second step up in basis when my spouse dies. So that is a tool we use a lot. The disclaimer trusts also say if the survivor files a disclaimer, the assets go to a bypass trust. One of the most important tools here might be just making the portability election from a tax perspective. And then if we have estates that are clearly taxable, the IRS has said if you don't use your exemption, you lose it. So if it goes from 12 million to 6 million, you might have lost $2.4 million in taxes you could have saved had you used that exemption up before it went down. And if there are no retroactive changes, you can give away up to $11.7 million in 2021, use up that large exemption amount, and also freeze the value of the assets transferred by keeping them out of your estate. So you have to think about successive generations then. Now, obviously, not many people have to worry about this. Most of us are in the clearly not taxable range, but there's a growing number of people in that middle range. So the summary, the future rates and exemption amounts are unknown, but probably going down. You need flexibility in your planning, and maximizing basis may be more of a concern than transfer taxes. You should always make an evaluation when someone dies who's married, whether to make a portability election. And for estates that exceed the current exemption amount, you have to look at using your exemption. It's not always a good idea, but sometimes it might be. So that's a lot of information packed into a few minutes. But if y'all have any questions, I'll be glad to answer.
Awesome job, Jason. Thank you. You did a lot and covered a lot in a short period of time. So we appreciate that. So I'll give a few minutes because people may be trying to go through that, and Michaela can tell me if she has any questions that she sees.
Don't see any questions at this time. see a couple comments, great information. There was also a comment that said it is tough to think about, especially during grieving time. It is surprising that sometimes assets are more than a family actually realizes.
Yes, absolutely. That's a great, and that's my point, and why it's so important for us to host a Keeping the Farm workshop every year, and for Jason, and we've had several other ones present on this topic as well. And we usually do, when we're there in person, we do a great job talking about estate planning as well, and that's really what it kind of goes into, is estate planning and tax advice and doing that. And I think it can kind of show from Jason's presentation that, looking at the next generation and looking at farm planning and estate planning down in the future is very important, not only for taxes and things like that and making those best decisions, but just to make sure that the next generation and stuff is not caught off guard and not knowing, what to expect to come up. That's something that we've worked with local farmers and landowners here in Wake County a lot, of trying to make sure they have a plan for that next successional type generation coming up, and the know how to if they want to keep the farm and keep it productive, making those correct decisions and getting the right advice. And so I guess we can kind of wrap it up, Jason, by saying, that it is very important for those that don't have a plan in place, that don't know the answer to some of these questions or what to do, is to get advice, not necessarily with you, Jason, but somebody that's an expert in this topic that knows this and that can help them answer those questions and plan for the future. Would you kind of wrap that up and say that, Jason?
Yeah, absolutely. And I want to mention one more thing from Maria's comment, that it's tough to think about this when you're grieving. There are also some time constraints on when you can make some of these elections. So, for instance, a disclaimer must be made within 9 months, and you have to file an extension for an estate tax return, and the final is due within 15 months. So there are a lot of things you have to do, and if you haven't thought about this beforehand, then it can be a problem. So certainly there's a lot of good lawyers in Wake County that can help people with this.
That's right. So, and like I said, if you have questions, need us to refer you or whatever, just please contact us. We'll, like I said, provide our contact information so that we can put you in the right contact with Jason and anybody else he can refer you to that can help you with this kind of advice and questions. Like I said, he's not trying to provide professional advice, but at least make you educated on the kind of things that can happen and what's going on and the changes as they come about. And like he says, they're constantly changing, can go up and down, and you just don't know from year to year or from 10 years from now what that value is going to be. And so it's important to be proactive and go ahead and have a plan in place and know what's going to happen before it happens.